Kavya, can you just confirm if it is okay? The audio is okay? Okay.
Welcome, welcome everybody. Let's just give everybody another minute to join in. So I think we can start since it's 4-1. Welcome everybody. Welcome to the Brown Bag session on understanding, monitoring, and trading of carbon credits. This session has been organized by the Capacity Building and Partnerships team as well as the Time Lab team here at DMEO or Niti Aayog. We are joined today by Mr. Santosh Singh and Kavya Hari from Intellecap. Mr. Santosh Singh leads the energy and climate change practice at Intellecap. He supports clean energy entrepreneurs with knowledge, network, and capital solutions. He has more than 15 years of experience in base of the pyramid market development with a focus on energy access, climate resilient agriculture, and climate finance. Um, he's also supported here by Ms. Kavya, who has experience in consulting focused on market and policy research, landscape studies, enterprise development support, and monitoring and evaluation across the sectors of renewable energy, climate change, natural resource management, and livelihoods. We are so happy that you can join us here today. Before we get into the session, I will just let everybody know the agenda for today. So we have the presentation by our speakers for around 25 to 30 minutes. Followed by that, we will have two discussants give remarks and comments. Following that, we'll have an open Q&A session. So you can post in your questions in the comment box or later on during that time. You can just unmute yourself and speak. At the end, we will have closing remarks by Shailendra Dwivedi sir, who's the Joint Secretary at DMU. Without any further delay, I now hand it over to Mr. Santosh Singh. Thank you.
Thank you very much. Pleasure to be here and looking forward for this conversation. I'll quickly kind of set the context because it's a topic that can go quite deep, and we have a task of kind of talking about the most things in this 20 minutes. So apologies for skipping over certain kind of details, but I look forward for your questions, and if you have any pointers, you can just point it out and I can go into detail. Before I go into that, let me just quickly give you more context in which I'm going to speak about that. So as my colleague pointed out, I lead the energy and climate practice at Intellecap, and we are part of Aviskar Group, and Intellecap is the advisory arm of that. As part of our Aviskar Group, we have many capital solutions, and we have an Aviskar Capital that has 8 funds which invest into early stage enterprises, and we are coming up with another fund that would invest into nature-based solution carbon markets. And in that process, we looked at multiple dimensions. So happy to share that Intellecap is advising that fund to be created. So we looked at into deeper part of the carbon market, which is fairly new construct the way it is emerging. So with that, let me kind of give you overview of what I have. I think I'll go with some broad discussion on what is the carbon market, how we differentiate. Then we talk about how the carbon market is evolving, what are typically the way we look at the carbon credits to be generated, and how carbon credit generation process, verification, and other dimensions of that are linked. So the purpose is to expand this discussion with some more kind of clarity, but I don't think that we would be able to kind of give clarity on all the topics that we're talking about, but at least we'll try our best to kind of expose as many dimensions as possible. So with that, let me just go to the next slide. Can you just confirm, Kavya, if the slides are moving there?
Yes, Santosh.
Okay. So, broadly, the carbon market, and I'm assuming that people know about carbon market. Basically, the basic of the carbon market is that there are certain activities that can reduce carbon emissions or remove carbon emissions. So, we look at them, and then there's a broader construct the way it works. So I'm not going into detail, but typically the carbon market right now, when somebody talks about carbon market, they are talking about either a compliance market or a voluntary carbon market. So that's the two things we need to understand. There's a compliance carbon market and the voluntary carbon market. Compliance carbon market is primarily driven by the country's commitment to the NDCs. And as part of that commitment, they have certain kind of legal provisions set up into the country that we would reduce the carbon emission from these sectors, and they put mechanism to that. So I'm not going into mechanism, but one of the most common mechanism is, emission trading systems. This is a system where somebody, given a target that you cannot emit more than A, B, C, or XYG, levels of emission. And if you do more than that, then you have to either pay penalty, pay some kind of cost to that, or you have to trade with someone who has given the target, reduced their emissions, and they have some kind of additional carbon that they can sell. That's the basic idea. So compliance carbon market is bound by legal kind of setup. So that's the one big thing that differentiates the compliance and voluntary carbon market. Slides are there, so I'm not going into slides because we have limited time. I'm just giving you the broad contours, and we can look at this thing. Now, there are multiple ETSs right now functioning, and India also has an ETS kind of mechanism, but not ETS. Those who are looking at the energy efficiency certificates or renewable energy purchase obligation can be called an ETS, but not typically an ETS, primarily because the units being traded is not carbon. The energy efficiency certificates or renewable energy purchase are traded, but not the carbon. So technically, they are not the carbon trading schemes, but they are very, very similar to that. And there are a number of things happening right now to convert them into a carbon trading mechanism. So that's the discussion. Those who are following up, there is an in this session, there is an act being put for amendment, Energy Conservation Act. Technically, that will allow the energy certificates or others to be made equivalent of carbon credits, and that can be traded. So this is the market which is driven by compliance. Some of the hallmark of compliance market is that it is not, there are certain sectors that you can choose. There are certain entity you can choose which will be given target and how they work. All of that I think is quite known, but I just want to highlight the difference between a compliance market and a voluntary carbon market. Now, voluntary carbon market is primarily driven by the corporate's goal of meeting their net zero commitment. And these commitments, as you know, are voluntary. They are not talking about, that I commit to this and somebody would penalize if they don't meet that. There can be pressure by activists, there can be pressure by shareholders, but not necessarily a legal pressure. So voluntary carbon credit is basically driven by the, corporate's voluntary commitment, and it has all the basic natures of the carbon credit, very similar to the compliance market. Only the process of registration, the process of kind of a verification differ, but technically they are basically the same units. They are all talking about 1 tons of carbon reduced. Uh, I can go into detail of how they differ, but one key thing is that in the compliance carbon market, it is primarily led by the government setup. Government is the one who is managing the registry. Government is the one who is authorizing people for verification, etc. In the voluntary carbon market, there are many bodies and there are some kind of voluntary association that drive the whole process. What you see on the screen, there are some common registries, gold standard, Vera, social carbon. These are the registries where you register that I'm registering a project and I want to be counted for the activity that can remove carbon or reduce carbon. So that's the broad contours. Going back to the next slide, I think if you look at why we are talking about that, carbon market right now is very hot in terms of the growth as well as in what we are seeing the future potential. We have tried to kind of give you some estimate, but if you look at that, the compliance market is already 22 trillion. This is the number of trade happening globally into registered emission trading systems. And there are, Kavya, correct me if I'm wrong, I say 25 to 26 ETS functioning right now. When I say 25 to 26, these are not 25, 26 countries because some ETSs are multi-country, some is, ETSs are within the country, but these are the distinct 26 emission trading systems that are working there. The voluntary carbon market is basically claimed to be around $200 billion, but this is a very conservative estimate. The very, very conservative estimate that we are talking about, primarily because we have number of assumptions and a lot of things depends that how difficult it would be for you to reduce the carbon emissions, say in 2040. If it is very difficult, then the prices will be very high because demand supply would play. But the one message that I wanted to give is that the carbon market is very big and both compliance and voluntary carbon markets are rapidly growing, and that's why they're attracting a lot of attention. They are being seen as an instrument for the countries to get financing for their carbon emission reduction goals. And that's why countries are very interested to have these kind of mechanisms so that they can meet their NDC or the commitment they have made to the carbon mitigations globally. Kavya, I can't see a lot of the screen, so if anything is there, you just have to stop me and say that. This slide basically talks about the carbon prices. If you look at the carbon prices, the way they have been moving, you get a picture. So in 2016, EU ETS carbon was being traded at $5. In 2021, it moved to $50. I'm talking about a compliance market here. So just looking at that. This is the ETS prices. There are some other mechanism for carbon as well. These slides indicate, and I had hinted that apart from carbon, ETS, we have carbon tax, another form where carbon can be priced. So you can see that a carbon tax in many countries that is practiced. And basically we say that if you emit X amount of carbon, this is the price you have to pay per ton in form of carbon tax. India is not yet kind of implementing any of measures, but these carbon tax and the ETSAs and the voluntary carbon market, somewhere they are linked. So one movement in another result into some movement in another, because basically you are talking about the same set of activities or similar kind of outcome. Moving on to, I think some of the point that I want to make here is that all the carbons are not same and different kind of carbon fetch different prices. So if you look at the sectoral prices of the carbon, say if you reduced emission by wind energy production, so baseline is there and then you reduce there, how it is being priced and what people are willing to pay. So the red lines ones are the one which are highly priced, and I'll come back to that later. Why, if the carbon unit is the same, why there is a different price coming from the different sector? Okay. So just dwelling upon this, if I can explain this, because this is not the purpose of how the carbon is priced, but one principle is that if a particular sector has a lower cost of producing carbon credits, which means that you can do an activity in that sector that can easily reduce carbon emissions, then the prices are on the lower side. Second, if they see that these carbon credits produced from the sector are not having any additional co-benefits. When I say co-benefits, we are talking about you can produce carbon outcomes from different activities. And if in order of kind of getting that carbon outcome, you also have certain other co-benefits, then in the voluntary carbon market, there is a higher price for that. An example would be if you look at this Kukustu project, if you see the fuel switching, or you see the livestock methane, they are very highly priced. The average price is $11 if it is coming from a fuel switching, which is a basically improved cook stove project. Why it is so? Because in the development world, when number of SDG goals are being met by this along with the carbon commitment, they fetch better prices in the voluntary carbon market. So a cook stove credit gets better price than say renewable energy project. That's the point I wanted to highlight. I think we can go into details if we have questions, but the takeaway is that different kind of carbon projects have a different kind of market price, and that creates a lot of confusion. But that's how it is right now. Now, just quickly want to kind of give you a sense of how the carbon asset gets created. We talked about that there's a market and then there is a different pricing, but what exactly happens? So typically, this is a slightly verbose slide, but I just want to give you an example of the steps involved in the carbon project. So you look at a particular project design and see that, okay, this is what I'm going to do. And doing this would reduce some kind of carbon, either remove carbon from the air or reduce the carbon from the baseline. An example would be that you are going to do agriculture in a different way. Say if a rice cultivation is releasing a lot of methane, but you change the practice that the way you do rice cultivation now would not release as much methane as it was supposed to do earlier, then you can claim for a project and get carbon credit. Similarly, if you're saying that I am going to produce power through solar versus power from any other source, so I'm reducing the footprint and you can register for the project. So the typical, there are 7-step process. I just want to kind of give you, and the slides are with you. You conceptualize a project, you go to a competent authority and saying that, I want to kind of register this project. Is it possible? Is it just look at the whole mechanism? They validate this whole thing that, okay, what you are claiming is backed up by science. There is a proven methodology in their kind of kitty. And once they are satisfied, they register the project. Registration is just a process where you are saying that I know of a project that is claiming to reduce this much of the carbon emission. So that's it. Once you have registered the project, then after you have committed the activities, you have conducted activities, you call for issuance, and the designated agency come monitor your project, do the verification of your claim, and if everything is assigned, they give you a carbon credit certificate. And that carbon credit certificate can be traded in different ways. The process by and large remains same for compliance market or voluntary market. However, the agencies change. So in a compliance market, registration, monitoring, verification, issuance is done by the government designated agencies. Say Bureau of Energy Efficiency does that for e-certs. But in voluntary carbon market, you have agencies which have different kind of mechanism. Vera is a very common one. Then there's a gold standard. There are some others. So they will follow their own processes. Um, Going to the next slide, I think this is just a depiction of how the project happens. You have a project idea, you do the feasibility study, you manage for financing, you start doing the project activity, and then you get the carbon credit, which you monetize. We'll share the slide deck, but this is the entire depiction of a carbon project, that the way it happens. Now, this is slightly kind of a verbose slide, but I think I wanted to highlight a few guiding principles that what we need to be aware of, whether all the activities that can reduce carbon, they are eligible for that. Many people say that, okay, I do a project and am I eligible for a carbon emission reduction certificates, or can I get that? There are certain principles that we apply to see that whether this is a good carbon project or whether it can happen or not. One is that the carbon credit should be real. It is not a theoretical construct. So somebody should be able to verify that you have reduced 1 ton of carbon emission, or you have removed 1 ton of carbon from the air. It has to be measured, monitored, and verified by multiple standards. So that's the real, it has to be real, it's not notional. Second is that, there is a concept of additionality, and this is a slightly nuanced in different contexts. The first principle is that we assume that in absence of carbon crediting mechanism, this would have not been possible. So an example I can give you, say you are doing something as a business and you are improving your processes because it makes economic sense for you. And technically that is, you can go and saying that, okay, I want carbon credit for that. The question would be whether it was viable without the carbon credit and you are supposed to do it in any way. Then it is not additional. Then it is supposed to be business as usual and you should have done that. But say we go for a project which we know that if there was no carbon money, there no carbon crediting mechanism, that project would have not been possible. So if you are saying that there are many farmers who can plant trees, but they are not doing it because they are not aware of that, there are no saplings available, there is no kind of nursery available. And if we get money to build that ecosystem, farmers can plant tree and that can be qualified as additionality, because in normal case the farmers were not going to plant trees and preserve them for a longer distance. So this is additionality. Then typically, as I told you, that there is a baseline case, that everything is judged on a baseline, that what is the baseline from which we are measuring. So that's a business as usual scenario baseline. Then there is a robust mechanism based on the methodology for monitoring and verification, monitoring, reporting, verification. One critical thing is the permanence, which is again a very hot topic in discussion. A lot of questions about the carbon. This comes into picture when you say, oh, I'm preserving a forest and hence I want the carbon credit. And some people say that, okay, you are preserving the forest for 10 years. In 20th year and or 15th year, somebody basically burns the forest or there is a forest fire and the carbon gets released. So it's not a permanent solution. So you got the credits, but you have not been able to kind of prove that the carbon sequestration, the carbon benefit were for the longer thing. Another concept is minimum leakage. While you are doing that, while you might be doing carbon mitigation reduction, but there are a lot of leakages. Leakages, you can think of that if I'm saying that I am going to do agriculture through a particular practice which would reduce the carbon emission, but as part of the practice, you started using diesel. So the diesel need to be removed from the overall benefit you are talking about. We call diesel as a leakage. So earlier you were not using diesel, but you are moving toward climate smart agriculture, but there's a diesel that you start doing. So we'll look at the footprint. There is a double counting. Double counting gets talked in multiple kind of contexts. One context is that at the country level, you'll hear that double counting because the corporates can buy the carbon credit and voluntary and NDC. There are so many discussions on that. But one is that one carbon credit should not be counted towards two climate goals. So it is should not be that if India has claimed that carbon credit for its own NDC, the same carbon credit is being claimed by another country for their own NDC. It has to be for one. So double counting is avoided. And last principle is that you should not be causing any environmental social harm. Now, uh, just monitoring and verification, I think top level, what I want to highlight here is that basically, the measurement is about the 6 GHG gases. And in the compliance market, we basically measure this with a certain framework, but primarily we measure for the obligated entities. These are the entities into a compliance market or in a country NDC, which have been given a target for emission reduction. So we measure that. In India, you can see the sectors like power, cement, steel. They're all part of the obligated entities. Now, what kind of measurement we do? There are three kind of emission we typically measure. Not necessarily all qualify into the compliance market, but one is the direct emission that as part of the facility comes. Second is your energy consumption emission footprint, and third, your other emissions that is linked to your consumption, production, etc., etc. So scope 1, scope 2 is fairly straightforward, but there's a large chunk of scope 3 that is complicated to kind of measure and very complicated to kind of even get rid of. So this is where a lot of corporate focus is there. Now, these measurements are verified by a set of agencies which are accredited. In India, Bureau of Energy Efficiency does that for ESERTs, and they have a number of things, but in most countries, this is there. So this is where the verification mechanisms come into picture. I'll not go into details of this, but we have given this in the slide, and probably if somebody has a question, this is a kind of mechanism for EU ETS. I think Kavya is EU ETS or is a common? Just let me see. Yeah. So this is for EU ETS, and it's common for most of the ETSs. So this is what gives you that what are the kind of agency involved. So there is an operator, then there's a competent authority that does all the kind of frameworks and does the spot checks. Then there is an agency that verifies, and then there is a accreditation body that issues the whole thing. I think this would be something that is emerging in India, and Niti Aayog might be looking at some of these things, that what role they can play. I think there is a need for a technical agency to guide the country on different kind of MRB protocols for different sectors, different kind of mechanism. Right now, these systems are very well established for obligated entities. Which are right now under the obligations of PAT and ECERT. But the moment you talk about the non-obligated sectors, sectors which do not have a target, sectors such as forestry, sectors such as waste, they do not have a target that how much emission need to be reduced, but they can contribute to the nation's goal by removing or reducing the carbon emission, but they're not part of NDC. For those, we don't have a proven way that how we can set up MRV mechanism, how we can set up the sectoral understanding so that those carbon credit can be acquired and can be traded by the competent authorities for the corporates and anyone else who is looking to kind of get the carbon credit to meet their voluntary or compliance goal. Uh, I'm just skipping that. I think I just summarized that. Um, the one thing that I want to highlight is that how we typically measure this GHG emission is basically sum of all the activities that you do in order to produce a thing or in order to provide a service. And we look at each activity and its emission factor. A simple example would be, say that you are consuming 5 units of electricity to run a light. That's an activity. Now we will look at that. Lighting house is an activity, and lighting house has this emission factor because producing 1 kilowatt of power has this much emission factor that at country level we decide. Typically in India it's like zero point 0.6 points, in the range. So we look at all the activities and look at their emission factor, club it, and saying that this is the GHG footprint of this particular activity, this particular facility, this particular sector. These are very standard processes. UNFCCC has multiple kind of guidelines for different sectors, but also at the country level, all the nodal agencies have a very detailed kind of guideline for how to measure that. This becomes complicated because you need to understand a particular sector to see what are the activities there and how we can measure. So as you see, while we are measuring carbon, but measuring carbon into a steel factory and measuring carbon emission of a transport versus measuring carbon emission of a building is very different. So you need to look at that, how we can capture the data. There are a lot of technology play here. So you can put sensors, the reliability of the data has emerged. Even the sensors can automatically send the data to your dashboard, which can be your reporting has been eased out. So there are a number of innovations happening, but still there is a lot of play for building this robust ecosystem that can get the data and put into a proper format. It's not yet automated. Looking at the MRV process, I think that's a simplified, but all the emission reductions are monitored, and these are monitored by the project proponent. So if you are saying that in a compliance market, a steel factory is a project proponent, they would be monitoring all the data through sensors, and they provide that. These data is given to the verifiers, which are accredited agency appoint or authorized, and based on that, these are kind of verified and certified in a different mechanism, and you get a carbon credit or a certificate that you have achieved the target. That's how it works. The way it is calculated, when you start the project, you create a baseline data that, okay, my carbon emission is X. Then you do a project activity and then you measure again that, okay, I have reduced from X to X minus 5. Then the 5 would be qualifying for the emission reduction. So that's the basic calculation. So depending on your baseline, you can get more or less from the same activity. That's the critical way to understand. Just quickly, I think I'm on the time, a couple of minutes. So we are also working with different agencies to set up the framework for India's carbon market. This is the typical carbon market framework looks like, and I'll give you where a lot of things are happening. The policy level, think of ministries like Ministry of Environment, Forest and Climate Change. They are the one who decide the country's pathway and work on what are the kind of mitigation goals that are looking, how this goal is aligned to their Paris Agreement commitment. Once they have that, then they put up a pathway for different sectors. And at the sectoral level, different ministries and different agencies start putting that, okay, I will put this kind of mechanism and reduce the carbon footprint of these sectors. Those are the ones which are basically converted into ETS and participate into that. So this is a very simplified implementation. The way we are looking at a national level also, we see a need for an advisory committee that provides input to MOFCC or whoever is coming on board. Then at a sector level, at a nodal agency level, you need to have these technical committees that would look at the MRB protocols, look at how the kind of data is collected, what the technology play can be, so that we can convert some of these outcomes into carbon credit. So that's how it will work. There are a number of things that we require to do that. You require a country level carbon registry. You need to have a footprint of different sectors saying that this is the baseline. So we are talking about building a national registry of GHG inventory, and there is a one that already exists, but that need to be kind of further improvised. Then if you want to kind of trade carbon, if you want carbon to be traded among the compliance market players as well as those who are participating in the voluntary carbon market, you need a trading agency. You need somebody who is managing the carbon trading platform. Think of national stock exchange the way they manage normal exchange. You need an exchange. India has a couple of exchanges, energy exchange and the others that there. Then you have a number of other bodies that basically does the registry and other functions. So this is a broad contours of the carbon market. I think there's a lot of literature available. We can look at that. I just want to kind of give you that the MRV systems are completely changing these days. This is a digital MRV system that we are talking about. So digital MRV system, basically what happens that you at a facility level or at a project level, you use a lot of sensors and remote monitoring technology to capture the data. And the data gets automatically reported to a centralized database of MRV system. And once this is verified, it goes to a registry where it gets converted at how much carbon credit have been generated. And then it can be traded on exchanges, or it can be also put in a warehouse. You don't need to trade. You can say, okay, I'm putting into a warehouse. World Bank is building a warehouse and saying that it is available. Somebody can buy in future. And it all works in sync with the UNFCCC protocols. So all the national level registry can meet at a meta registry that UNFCCC is building. So all the countries can see how this is preparing up. So this is the emerging area where I think Niti Aayog can actively look at and see how it is emerging. We can surely provide some more context to that, but just skipping that. This is typically a depiction of the carbon market, a very simplified one. In a carbon market, you have basically three components. You have a national GHG inventory for each sector that basically captures the emission and removals as per NDC. Then you have a national registry that basically records all these kind of project and the outcome that comes. This registry talks to the registries of other countries and UNFCCC registry so that you know that if you are in excess, you can trade, or you are in shortfall, you can buy. So this is the global level connect, but also it connects to different exchanges where this trade can happen. So buyers can buy and sellers can sell. This is a very simplistic carbon market measures. There are a number of things that is needed to make a carbon market works, like uh, derivative markets and measures for liquidity, measures for all these things. The typical stock market regulations and stock market mechanism apply here to maintain the demand and supply. This is a very simplistic way of highlighting how the carbon market works. I'll stop here. There are kind of annexes, but I just want to kind of stop here and see. I think we had 30 minutes, so I'm on that. I can give you some more context, but I'll stop here.
Thank you for your presentation. Before we go into question and answers, I would first like to invite the discussion for the session. Param Jyoti Chattopadhyay, who is an M&E specialist at DMEO, for his comments.
Okay.
Thanks, Nicole. Hi, Santosh. Very good, very informative and interesting presentation. So it's actually it's a fascinating area which is yet it is evolving very fast, and it was great to understand the way it is functioning and how it's going to your views on how it can evolve in future, and especially the part you highlighted on the non-fungibility of the carbon credits, where you mentioned that not all credits are same, that some of them are priced higher than the others depending on how difficult it is to create them, and also what are the other objectives that carbon credit, the process of generating that carbon credit is fulfilling. So So that actually brings us, to another important topic, which I just wanted to make this discussion a little broader, in the sense that uh, now when we are talking about different prices of carbon credits you know, uh, so then how the price is or the price discovery happens. You talked about the carbon trading, the trading platforms and the markets which are there. So if you throw some more light on how the price discovery of carbon credits happen. Second part, which I wanted to discuss and also wanted you to throw some light on, is that how the carbon market and carbon trading is linked to the ESG investments. So I understand that carbon credit is a very important component of ESG. And I'm sure that you are aware that one article came out a few days back in The Economist, which is quite kind of critical of the ESG framework as such. So for the benefit of others, I will just quote some of the lines which that article has mentioned. So this is in the context that now it is the perception in the general public is that ESG is becoming a comprehensive solution to many of our environmental and social woes. But the article says that the it is very complex. Number one, ESG is not a sure solution, because number one, it is very complex because it is a large array of objectives which is trying to cater to. Second is that the incentives are not very clear for many of the objectives that they are trying to target. And then there is a measurement issue. The measurement problem is there for many of the objectives. So for that, the author of that article is saying that it is now required to unbundle the three letters ESG, the environmental, social, and governance. And then probably we should focus only on E, and within E also only on emissions, not on other things. So emissions is directly linked to carbon credits, which you're talking about. So what is your view on that? So this is a very interesting topic, which is now evolving, what I understand. So if you could throw light on these two areas, one is the price discovery mechanism, and second, how it is linked to ESG and what is the way forward? How do you perceive? Over to you, Santosh.
Okay, so Param, thank you. I think there are two very important questions, and they can have their own seasons. These are like very hot topic right now with the economics cover story throwing everyone some very pertinent questions. But let me just come to the first question, the price discovery part. The price discovery part, again, whenever we talk about carbon market, we always classify that compliance and voluntary carbon market, right? So compliance market price discovery is primarily can be forced by the way the ETS mechanism is decided, right? So say that and I'll give an example, some of the emission trading schemes struggled with oversupply of credit and no buyers because the targets that were set were very easy. So everybody achieved the target. So everybody achieved the target, then nobody is looking to buy the carbon credit. And everybody is saying that I have produced this many credits because the targets were very easy to set. So if I'm saying that can you reduce 5% of emission, technically there's a possibility of reducing 30% emission. So that person went and reduced 30%, and that is saying that, okay, 25% additional, I have a carbon credit, can I sell it? So one is that in the market design, which especially in the compliance market, the target setting becomes a very key factor in regulating the demand and supply. So that's one. Second, technological innovations and other sectors which are very difficult to abate sectors, what we call hard to abate sectors, if they see that there are two factors to that. One, if I am forced to comply to a particular kind of target, what is the cost of meeting the target versus what is the cost of getting the carbon from somebody else and meeting the target? So think of this, if you can meet your carbon emission by doing intervention in your factory at a lower price than buying the carbon credit, then you will produce yourself. You're not going to buy. But if you see that, okay, there's a carbon credit available in the market at $6 and reducing 1 ton of carbon emission requires me to invest $7 per ton, then I would rather buy. So the two are, very linked because the harsh targets make you think about, and when I say harsh target, I am talking both in terms of cap and the penalty, that what happens if you don't meet the cap. And so this is the one price discovery. Second, in the voluntary carbon market, corporates have started committing to net zero goals. And they are seeing that if I want to be net zero and there is a pressure and it is just a matter of time that how I would be, held against the words I'm using, because net zero is not defined very clearly, a lot of confusions around that. So they're saying I will be net zero by 2050. and they see that in order to be net zero, I need to use my residual emissions to be offset. And I see that there are a whole lot of corporates chasing a very small set of carbon credits. So they started to kind of acquire carbon credit for their future needs right now. So the demand supply in the voluntary carbon market is very critical factor. So just wanted to give you some thought on the price discovery. And coming back to the ESG and the carbon market linkages, the one critical link is, Param, is that in the E part, emission is one of the biggest factor that everybody talking about in terms of environmental footprint of the businesses. Now, in India, the corporate ministry has put a very clear mechanism that all, the SEBI puts a order that business responsibility and sustainability reporting now requires that top 1,000 firms provide their emission footprint. Now, the top firms, when they provide emission footprints and other kind of details, they would be looking to kind of achieve a better score on E front by having lower emissions per product, per kind of footprint that they have. Now, in order to do that, they have again only two ways. They do the change in the way they do business, the way they operate, and reduce the carbon emissions, or they start buying from the carbon market, which can be qualified as a valid offset of their carbon footprint. I'm using the word qualified as valid offset of their carbon footprint. So I can say my carbon footprint last year was 100. I bought carbon credits worth 50 ton. So now my carbon footprint has reduced to 50, and this consideringly impact the E part of the ESG, and hence I'll get a better ESG score. So that's the linkages there into the ESG. Right now, the way ESG is being criticized, so I'm coming to the second part, some nuances, Param, that you asked. The criticism of ESG is primarily coming from the fact that there are three dimensions of ESG. ESG reporting, ESG investing, and ESG as an impact measure. Now, let me touch on the ESG reporting. ESG reporting is basically just highlighting that I am reporting my footprint, I'm reporting certain details on different parameters. So many of the ESG movements are right now at the reporting level. See, that's, there's a TCFD, there's a TNFD, all are basically asking disclose your footprint. The second set comes when you are talking about investment based on ESG, where investors are saying that I will invest into businesses which have a higher ESG score or better ESG mechanism. That basically is driven by the fear that if your ESG is not very solid, you have a long-term risk or disrupting business. I'll give an example. Two of the biggest firms globally in terms of the fossil fuel operations, they cough up penalty of $40 billion and above, primarily because they did not have the measures and resulted into big chaos legally. So ESG investment is basically saying that I'm investing into those businesses which have a higher ESG score within the same bracket. Understand, it's not higher score across all the verticals. Somebody curious, the criticism, those who understand Philip Morris International, they are into business of cigarette making, right? Tobacco. So technically the S part is very controversial. But they can get an ESG score, and they're claiming that our ESG score is improving because the way we produce tobacco, we are emitting less. So the tobacco production process is becoming more efficient, and that is creating lower carbon footprint. Do you see the argument? So the meeting this kind of argument is the one which is basically throwing people saying that, okay, you need to give a very clear indicator. That's the argument, Param, against the economists claim that emission is the only thing that matters. So by that logic, if you have a baseline for cigarette production, you can say that my production has become efficient, so I claim the ESG benefit because now I am producing cigarettes with a lower emission footprint. So there are a number of discussions happening. We're not going into the sectoral topic, but these are some of the things that has. The last part I think I covered on the ESG as an impact, whether ESG is enough. That's where you start having a goal. So net zero goals, being the product level carbon neutral. These goals basically take the ESG to the next level. It is saying that I will become carbon neutral. I will become, my footprint will become. These are the goals that will take ESG to the next level. So ESG is a framework right now for reporting, for setting targets, for giving focus on certain things, but it is not the end goal. I think ESG space would evolve drastically as these kind of conversations start happening.
Thanks, Santosh. I think these were very informative. I think everybody would like to hear more from you. So before we open this to the to question and Q&A from the other participants, just one final question from my side. You talked about this World Bank's climate warehouse you mentioned, right? They're creating this warehouse of carbon credits. So this also is a very old concept, no? Because I remember when in 2007-8 also this concept of carbon banks, carbon credit banks were floated. So now my question is that so this is becoming a kind of a open trading platform where you have future markets. You talked about they're also planning to trade carbon credits in futures. So now the question is that who would be the regulators of this market? So what kind of any directions in that area, if you could throw some light on?
So compliance market, Param, it is primarily driven by the country government. So the regulations would be driven by the country level government, because compliance market is always a country's way of meeting their NDC commitment, and hence the agencies are the one which are part of the Paris Agreement, negotiations. Technically, the Ministry of Environment, Forest and Climate Change, and there is a apex body of implementation of Paris Agreement that under MFCC. So these are the agencies that look at the trading of the compliance market, and UNFCC is the one which is setting up mechanism to kind of have all those things, all the registries interact with each other, so that you know that who is committing what and what kind of goals are being done. So it's a part of a climate negotiation process where stock taking happens, and then the people report on the NDC progresses. So compliance market would be always regulated and kind of driven by the policy side, the government part. The voluntary carbon market, as I tell, it's a very fragmented.
Santosh, sorry, I'm just interrupting here once. So that part I understood, that the compliance market would be regulated by the government of the country government. But I am talking about the financial aspect of it, the financial transactions that happens. So then that should also come under SEBI, right? Presently, what is happening? Like, is there any kind of future trade that is happening in carbon market?
No, right now, at least in India, there is no carbon trade happening because the carbon market does not exist. The trades are happening of e-certs and RPOs, which are under the different mechanisms, so which is party schemes or the equivalent scheme that we're talking about. In India, the carbon transactions are only happening in the voluntary carbon market, and those are OTC. So there is no exchange right now where you can as an individual transact. There are some global exchanges, but the way it is happening and the way it would emerge, that's where we were talking about the governance framework for the carbon market, that say the power exchange or the energy exchange can become the custodian of the carbon trade, so equivalent of SEBI.
Right.
If
Okay.
these carbon credits are exchanged on the energy exchange, which is possibility, because they already have some kind of outcome based exchanges, so e-certs and others are being exchanged. So CRC become the regulator for the exchange.
Okay, understood.
Okay.
Yeah. So yeah, thanks, Santosh. So over to you, Nicole, if you can take the discussion forward.
Thanks. So before we go ahead, we also have Venugopal Mudkur, who's from the energy vertical. I know you joined in late, but if you have any comments, Venu, please.
No,
Yeah.
I've just joined in 10 minutes back, so I'm not able to hear a lot of the presentation from Santosh. But I would say, yes, I agree with Santosh's points in terms of the energy carbon trading market doesn't exist in India. The carbon market, which is voluntary in nature, is only of 1% in India. It has actually never picked up. So we are thinking in terms of moving towards a mandatory carbon pricing mechanisms. So the discussions are still underway. Again, it's a complex topic. Even if you look at EU's emission trading, which is very most popular scheme, it has actually never achieved the intended targets because a lot of allowances set in by EU, they've actually have not decreased their industrial emissions over the last 15 years. So with this point, I will just pass over it back to you, Nicole. So I'm sorry for joining in late.
Thanks, Venu. We now open the floor to questions. I see Ashish, your hand is raised. Please go ahead, unmute and speak.
Thanks for your informative session. A couple of questions. When we talk about monitoring the actual carbon emission, and you did mention sensors. What about alternative ways of monitoring it in terms of using carbon emission through geospatial data in terms of emission? And the veracity and the authenticity of because there would be some agency that will certify that this is the method of monitoring. That was my first question. Second question that I have is that while there is no market, secondary market to trade, do you think that in the interest of green, can the government or SEBI come up with norms where the actual equity price on the normal Sensex market is discounted because of not meeting carbon norms, or that gets factored it into the pricing itself? Okay, that was a second. And thirdly, not talking about India, but globally, are there any places where there are secondary markets where you actually do a futures in carbon trade? These were the three questions.
So, Ashish, I'll quickly respond to the first one. I think you asked about uh, the sensors and geospatial data and how it is,
Yes.
we can use. So both are being used. So geospatial data, if you can have a higher resolution imagery and you can figure it out that that's reliable enough to give you the GHG emission at a certain plant level, that is being used. So there are a lot of innovations happening. I think it is a question of at a national level that what we prefer. We prefer the ease of measure or we prefer the reliability, and that's a trade-off, right? So, but what is happening that geospatial data is being very, very widely used into the forest projects where you see that the forest is being denser, the trees are being growing or agroforestry projects. So geospatial data becomes very easy to verify that this project exists. Well, it might not give the total biomass that has been sequestered by the geospatial data, but at one level it verifies that you are talking about raising a forest or increasing the density of a forest. That can be verified by a geospatial multispectrum methodology that we use. So that can be done. Sensors becomes much easier when you are looking at the factories, etc., because it's geospatial data would not be able to kind of capture that if your effluent and other methods are kind of difficult to record. So that's the first question. I think second, Kavya, help me out. Second question was about the trade, right? Where is it
Yes, it
happening?
was about, yes. Do you think that on trading, do you think SEBI could possibly come up at a norm where the prices get discounted?
So SEBI is not yet kind of into that mode, but Assis, I can give you there is a certain kind of voluntary, things that are happening. So if you are actively looking at the global stock market prices, and if you go to certain portals, like for example, if you go to Yahoo Finance, and if you see the portals and see a share price of something, you will see a sustainability score. So not giving the carbon emission footprint, but they give you a sustainability score, ESG score, and there you can see. So there are people and the agencies are thinking about that. Every share can be linked to their carbon footprint or the environmental emission. To happen at a country level and a very systematically that it is linked to the price. I had a detailed discussion with one of the largest trading platform, and they said they were trying to do something, but at least at the buyer level, this information seems to have no kind of demand side signals. So it has to be supply side. That you are saying that I'm putting a carbon tax, it will become an equivalent of carbon tax. Not being done right now, but all possibilities are open for future. The one thing that I would do mention here is that National Stock Exchange, I know that they are in discussion with certain other parties to see if green instrument can be traded on National Stock Exchange, which can be green bonds, carbon credits, voluntary credits. So they are thinking about putting up a mechanism where these kind of options can be traded. But right now they don't exist for this thing. Futures and others, they are kind of being in certain kind of compliance market, they are there, and a certain kind of voluntary market, they are there. Just to give you, I had a discussion with London Stock Exchange, and they are launching a carbon exchange which should be operational in next 3 months. So they are saying that we'll list all the carbon projects with all the kind of details, the transparency, the verifiability and everything. And then those who are looking to get carbon credit can trade on that. Primarily, it is being focused around the voluntary commitments, Assis, because compliance market again would go through a very different route. So, but the voluntary market is seeing a number of these kind of initiatives. There are 2, 3 exchanges already operational. One is Air Carbon that you can look at it. Then the Climate X, which is in Singapore being launched. But there are multiple others. There are also exchanges which are quasi carbon exchange because they have tokenized the carbon credit. So agencies like Toucan or Clima, they have used the voluntary carbon projects to create a crypto token, and the tokens are being traded on multiple platforms. So a lot of things happening, but yet it is not a kind of label that we can say is a established market for carbon exist in India.
Thank you, Santosh. Thank you.
We have a lot of questions from Charlo in the chat.
Yeah, I'm just trying to kind of read that. So
Right.
give me, if you can, yeah, if you can phrase it out, then just, or Sarlo can speak and I can just respond to that.
Yes, thank you for the presentation, Santosh. So I'll go with the first question. First is in the one of the earlier slides, the carbon taxes was $101 and carbon price was $46 for Switzerland. So there's a huge differential. Can you put some light on it? Second, from the uh, perspective of India and also given the legacy of PAT scheme, which would be a better method from the perspective of administrative cost and the cost of creating that carbon taxes or the voluntary carbon markets, and which can be more acceptable from the business side? Is it the carbon markets or the carbon taxes?
Okay, so this is a very kind of polarizing topic, but let me give you my version. I think it's a personal opinion. One is that on the slide that you're talking about carbon tax and the carbon market. So understand that the carbon tax is basically, uh, more to give a signal that you need to reduce emission. I'm increasing the cost of doing business. So you have to factor that in, right? So if you put a carbon tax, technically you are making that business giving a signal that your cost of production is going to go up, right? But it is still not clear whether with the increased cost of production, they will reduce the carbon emission. You get the point? So when you put a tax, you are saying I'll tax more, but it is not giving you a kind of instrument. I know that emission would reduce by this much. So there's no emission target. Kavya, you want to add something?
Santosh, if I could just come in here. So just to clarify, so basically in Switzerland, there are multiple, so every country can have multiple sort of carbon pricing mechanisms that they implement. So Switzerland has ETS and it also has carbon tax mechanism. So the country, so the industries or the entities which are covered under the ETS are not covered under the carbon tax mechanism. So hence there is price differential. When we are talking about an ETS, so the price is $56 per unit in terms of the emission allowances that they can receive. And as Santosh was mentioning, it is related to an emission reduction outcome that has to be achieved by those entities. Taxes on other entities which are not part of the ETS, there is no emission reduction they need to achieve. And that is the reason that tax is higher, because it has to compel them to actually keep reducing their emissions until, or else have to keep paying increasing taxes as per the emissions that they are over exceeding. So that's basic difference.
Kavya, you're breaking up, but I'll just summarize. So that's what the point I was saying, that in a country you can have multiple mechanisms for achieving your carbon goal. So you can say certain sector will participate into ETS. I'm putting carbon tax on certain sectors, and I'm allowing certain other sectors to go scot-free. So that's why the differential comes into that, because there are different mechanism, right? So sometimes strategically you don't want to put a particular sector into one mechanism because it is critical for economy, it is critical for your own goal of growth. So these are decisions that are taken by the country level thing. So I think that was the first question that I think we have answered. What was the second question?
Second question was from the perspective of India and also the legacy of PAT scheme that we have.
So yeah, so I recall now. So we have been working, just for the full disclosure. I did work with Bureau of Energy Efficiency as part of an engagement, and they provided some input on the forthcoming carbon market. And we are working with World Bank for the India carbon market, and we did some presentation to different ministries. So the logic here is that we already have some experiences of trading outcomes, trading emission outcomes, or trading outcomes. So right now it is just a matter of that the outcomes can be replaced by some other kind of outcomes. So rather than energy efficiency outcomes, you can trade carbon emission outcomes. So the idea is that to leverage what is the existing framework and see that in order to make them trade carbon and in order to make a smooth functioning carbon market, what additional thing we need to do. So the going practice in India is right now is that focus on our own strength, like PAT and other thing we have done. Sectors are already kind of a given target. So see that if those targets can be converted into a carbon target, or those targets can be made equivalent of a carbon unit there, and that can be traded. Because once, so just to give you a very broad example, e-cert cannot be traded under the Paris Agreement, right? You have to create an equivalence because you are talking about energy efficiency versus a carbon, right? So one is that to put an equivalence equation saying that one e-cert is equal to half carbon or one e-cert is equal to 2 carbon, and then we retire from the energy efficiency market and put into the carbon market, and they can be traded. So in India context, we are looking at leveraging our experience of carbon emission trading from the RPOs and the PAT, and then convert into this thing. So it is a discussion right now. I think the clarity would emerge in a couple of months, or by COP27, we plan to announce our carbon market thing. So that's the thing. Carbon tax is something that India is not very keen on as of now. I think that's a signal because it is not giving you a clear pathway that I put this much of carbon tax emission will go down by this. But the sectoral caps are much easier way to say that I put the cap on this sector and I'm measuring the sector emission has gone down.
Okay. Thank you very much, Santosh. Thank you.
Since we are running out of time, I think we can end the question answer session here, but all participants, please feel free to message or email me later if you have any questions, and we can ask our speakers to answer it over email. I would like to thank all our participants who engaged in the Q&A session. Now, coming to the end of this brown bag session, I would like to invite Mr. Shailendra Dwivedi, sir, who is the Joint Secretary at DMU, for the final closing remarks.
Thanks, Nicole, and thank you, Mr. Santosh and Kavya ji, for what is a very informative as well as thought-provoking session. It's very stimulating as well. I don't know, the questions that the session opens up. We have not asked all of them quite surely. There are many more questions that perhaps we all have to dwell upon. Obviously, this is an area which is coming into central focus, as Param was pointing out, with the ESG discussion, the ESG framework becoming center stage to the world of business, economics, governance. The whole route towards making it possible somewhere would need all the measurements that we are talking about. I'm only afraid, whether we are simplifying things or we are complicating them too much to achieve what are common global goals, and whether this is the best way for us to go forward to get into these intricate measurements and the taxes and all of that stuff. Perhaps when it comes to the funding part of businesses themselves, that's where perhaps the biggest hit would come. When it comes to a business which is not environment friendly, which has got an unhealthy carbon footprint, for it to become unviable, that call would probably be taken outside the tax regime. It might just happen from the citizens themselves, and still all the same, we would probably need a way to measure so that it's more scientific. I don't know though what is the carbon footprint of the whole measurement exercise itself. Whether it is going to add to the whole thing a bit more than what we are ready for. So we need to have a healthy way in which to solve this biggest problem that we are faced with. The whole balance between the developed and developing world is a big challenge there. How we get about a a common way to solve that issue, which, because it's almost as if, there are three worlds today. One that has got time up to 2050, another which has got time up to 2060, and yet another where we live, it has got time up to 2070. I don't know what mathematics would apply for us to have different lifespans on this planet. There are very wicked issues over there. But the work that you people are doing, and I'm sure there are others in the fray who are trying to solve this problem for everyone. More deliberations required for us, maybe more discussions required. We would require perhaps broader inputs for Niti to take a stance, as to how we can advise the different stakeholders to take these solutions that are available forward to solve this biggest problem. Thank you so much for your time and for engaging us in this session. Hope we will continue this series, Nicole. We'll have more such sessions, and hopefully you can participate in some of them again, and come up as a panelist. We could have it in another format as a round robin or round table, and we can have some more intense discussion on this topic. 1 hour is not enough, but we had a great start today. Thank you for your time, and thank you from all of us here.
Thank you, sir.
Thank you.
Thanks, everyone. Thanks for your participation. Thank you.
Thank you, Nicole. Thank you for inviting us, and we feel very, very happy that we are participating in the process. I have put my email addresses and details there, and as anybody, I think I have missed some of the questions. Feel free to drop a line. We would be able to kind of provide response to that. Thank you very much.
Sure. Thank you so much. Thanks, everyone.